You're watching Stockwatch this week. I'm Ntaoling Lechela, and joining me to unpack your stock-related questions is Graeme Körner from Körner Perspective. Be sure to send your questions through via email at stockwatch@bdtv.co.za or via X using the hashtag Stockwatch or via SMS to 41392. Graeme, thanks so much for your time today. Now, before we get into the questions, let's just recap on how markets have been performing throughout 2025. At the end of last week, we saw markets plunge into the red on the back of that strong U.S. jobs report, which further led to fears around less rate cuts from the Fed. But things started to change coming into this week when we got that U.S. CPI and PPI reports. Then we got strong banking earnings also boosting sentiment, but markets in the red yesterday. Coming into today, futures in the green, really choppy trade. What's going on?
I think exactly as you're saying, there's just a lot of noise and confusion. I think the backdrop, of course, is, Donald Trump is going to be inaugurated on Monday. We've heard all the, the rhetoric around 60% tariffs on everything from China and 20% everywhere else. But I think one of the big stories is, in spite of the fact that inflation has largely been behaving itself in the developed economies, you've seen bond yields move higher. Talk of a tax on the bond markets, but the reality of it is that probably what is happening is the market is demanding an appropriate type of return, for the risks. If you look at the US, for example, the aggregate debt has rocketed. And there's a lot of uncertainty on whether, Trump and Musk and company are actually going to be able to see those budget cuts and bring the deficit under control. So I think there's a lot of angst around generally, but I think it's been a case, Ntaoling, of pro-US, dollar strong, most of everything else looking weak. Emerging market currencies obviously bearing the brunt of it. And then there's also, on the corporate front, been a fair amount of news. So, for example, if you think about Naspers with Tencent, not long ago, added to the China military list, that share got hit, 12, 14, 15% in a very short space of time. And then you had, the likes of Richemont yesterday with phenomenal results, blowing out expectations. So, when you look at the index, it's not doing a hell of a lot. We're probably 4 or 5% off on a month view, and or maybe a little more than that, maybe a 3-month view, and off our highs. But there's a hell of a lot of volatility in the moving parts, and we've seen quite a lot of weakness or anxiety, I think, towards SA Inc. stocks in the last week or two. So it's been a very volatile and a very uncertain time in local equity market and I suppose in other asset markets in SA.
And that brings us to our first question, which reads, given the dismal outlook of the South African economy, is it really worth the time and effort to find value and growth in JSE stocks when those of the US and EU continue to outperform those of the JSE? I mean, it's not all that bad, Graeme. There are some bright spots on the JSE, right?
Yeah, I think so. And I mean, if you think, for example, as a South African investor, you have access to Richemont, which clearly is the standout of the the luxury goods companies, and you've got access to things like BHP. So within our market, even for South Africa pessimists, I think there are investment opportunities. But I agree with you, Ntaoling. I think there's an opportunity in SA. If you just look at the PE differentials, particularly US to SA, you look at some of the dividend yields, we feel that there's good value. Obviously, there was a lot of excitement post-GNU, and I think a lot of the weakness over the last month or two has actually been more around global uncertainty rather than SA story. So we feel that there's still an opportunity, but I think it depends on what you're looking for. So if you've got somebody who says, well, I'd like to be invested in technology, or I'd like to be in, electric cars, or I'd like to be in global engineering or industrial businesses, then clearly South Africa doesn't offer those opportunities. Yeah. But, within our investable universe, we think there's some very good companies and really, really good value, even after a fairly good rally from when the GNU was formed.
You touched on Richemont there and, the value that it provides. I want to just touch on the Chinese story on the back of Richemont. We did see sales come out tops. They were up 10%, I think, overall, but sales in China still declining. What's your sentiment around that growth story? We had China GDP numbers out today, topping market expectations. I mean, they've also hit that 5% target for 2024. Are you seeing value there?
In Richemont, I think, for me, Richemont is almost what you wouldn't expect in a way, because they deal in such a premium market in very, very expensive jewelry, predominantly, and in watches. You wouldn't think that sales and earnings would be as cyclical as they are, and or let's call it erratic. And some of it, of course, is modern accounting nonsense. But my sense is that those results were phenomenal. I think China's a really important market for them long term. But I think when I look at Richemont right now, I would say these blowout results might be more company specific and courtesy of one or two geographies, rather than maybe representing, the mother of all bull runs in luxury goods.
Yeah.
And I think, considering, the angst we're seeing around tariffs and what that could do, for example, to the interest rate outlook and inflation and disposable income, I would be a little bit circumspect on Richemont right now. Personally, I think the market obviously is rewarding them for spectacular results, probably a bit of short covering as well, because that kind of price action to me was a little bit excessive, given the size and the nature of the business. But what I'm saying is, I think the outlook, I would argue, is maybe not quite as visible as we would think. I think China, the growth, I often get the feeling, China gives you the growth number that you want, or gives you the data that you want. I do think they'll pull all the levers to get growth going, particularly if Trumponomics and the tariffs cause pain. But it's not going to be an easing operating environment for the luxury goods makers, including Richemont, although it is definitely, the standout performer. So, from my point of view, I think this performance that we've just seen is probably a high watermark for a while. And I think the multiple is not ridiculous, but it's sufficiently high to rather give me the sense that I'd rather sit it out right now, rather than chasing it, and seeing this as the start of a massive recovery in the luxury goods sector. You
mentioned that it is a start of a massive recovery within that sector. Would Richemont then be a fave within the sector? Or are you looking at an LVMH?
No, I think Richemont's model and positioning probably makes it one of the gives you that in a way a little bit more defensiveness maybe than some of the others, where I think they are kind of lower down the food chain, so to speak, relative to premium watches and jewelry particularly. So I think it is a little bit more defensive, than the LVMHs and the other luxury goods brands. But what I'm saying is, I think I don't think the sector is going to have this phenomenal 2 or 3 year run, which is really what you need in order to justify the kind of ratings that we're seeing right now. So I think Richemont is the most defensive. It probably gives you a little bit of optionality, but generally I'm just sort of sitting it out, because I think there's enough uncertainty around in the world, particularly in that sort of space.
Let's move over to Palantir. A viewer says, I bought Palantir at about $13 based on a stockwatch discussion. Is there still more profit in this one? I came across a graph detailing, a tops S&P 500 performers, and Palantir came out tops, Graeme. That share price more than tripling in 2024. More value on that front?
Okay, so I don't know it very well. But I think there's just been so much excitement in certain sectors. Obviously, AI has been, the poster child, but I think cybersecurity has also been top of mind for obvious reasons. But, when I look at Palantir, for example, and I don't know it well, but, looking at the forecasts on Reuters, on Refinitiv, I see, a company that's delivering solid but not spectacular earnings or revenue and earnings growth. Sitting on a 300 and something PE, I think, on a 1 year forward. And it's not, in my mind, at least on the numbers that I'm seeing, giving you the kind of earnings growth that you need for those multiples to even vaguely make sense. Because, they're not just blue sky. It is a competitive space.
Yeah.
And it's not like they can just keep on adding new customers and push the prices. It is a competitive space. So I think what I'm saying is, generally, but we're not sort of buy the narrative and close your eyes, in technology kind of investors. So for me, you pay a certain multiple. Sometimes in the case of, businesses maybe like NVIDIA, you're happy to close your eyes a little bit more than the rest, simply because you know that there's a lot of earnings momentum. But I'm sensing that a lot of, the Palantirs and the Crowdstrikes and even the Broadcoms of the world, they're not going to give you the kind of earnings growth that you need, I believe, in order to justify those ratings. So it's a little bit of, I wouldn't say bigger fool theory, but I don't believe it's based on pure fundamentals. So, to answer the viewer, I would say, you bought it for a reason. If it was a punt and somebody said, listen, I think the sector's going to do well, and it's a good opportunity, and it was really a shorter term trade, I would argue then, you tripled your money. That's pretty good. And you're also starting to see, I believe, the NASDAQ and some of the more highly valued sectors coming off. So I would probably bank. But if it was based on long-term fundamentals, then just go back and check your model and ask yourself, at what kind of multiple or what valuation you think is relevant or for that story. So what I'm saying is, I think from a trading point of view, I'd probably be inclined to bank, because I think the sector is generally looking a little overcooked. But on the fundamentals, let the viewer go back and just check their own narrative and their own story.
Sticking with that cyber security industry, there actually is a question on Crowdstrike. It reads, I completely missed the boat on Crowdstrike. It was trading at $220 in August 2024 after they crashed the entire internet. The current price around $360. Any upside here, Graeme? I mean, you mentioned that it could possibly be time to perhaps cash out.
Yeah, look, I mean, what I'm saying is, we buy companies, and sometimes people laugh at us for it, but we buy companies, we pay 100 Rand for something that we think has got a fair value currently of 125, and it's maybe got longer term value of 200, whereas what you're talking about here is you're saying you kind of, it's almost impossible to estimate fair value, because it's just so many variables. So, for me, I think it's on a third of the PE of Palantir, but it's still excessive, because these are that they're not infantile businesses. They've got products and customers, and they've got traction in the market. So it's not as though you're buying some AI startup. So for me, generally, I do believe, having said all of this, I do believe that that cybersecurity is going to be a massive sector. But I think if I look at the hack fund, for example, which is something we've looked at quite closely, I'd probably rather, if you're looking for exposure, I'd probably rather buy something like that, simply to get the diversification. Granted, you've got businesses like, maybe Broadcom, which is not pure cybersecurity, but I think I'm confusing myself. The reality of it is, I think the multiples generally across the board, if I look at the hack fund, for example, are just so stretched that I would personally, based on the way we invest, avoid the sector. But if people just, if you believe that you have to be invested in technology because that's the future and AI is going to spawn all these other industries, then that's your story. And, but I unfortunately can't add much value other than that.
Let's get into some local stocks. This one has some international exposure, 91. Please advise on the medium-term investment case for 91. I have held it for about 2.5 years now. It has been trading sideways and going nowhere. But in the last few months, the share price has been dropping off. I am glancing at a graph here, Graeme, and over a 1-year period, the share price is down 16.9%.
Yeah, absolutely. I think one of the problems that they had, we think of 91 as a South African company. This is a this is very much a global business. Massive assets under management in the UK. I think when cash rates went up, they lost some mandates in terms of, say, more of the growth-oriented mandates. But I think it's a good business. I think if you believe that asset markets, including South African markets, are going to do well, if you take the FTSE, for example, I think something like 91 looks very, very well placed, as does Coronation, frankly. Both really big businesses, although Coronation, obviously, more of a South African investment business. So I think the outlook, based on the fact that I'm mildly optimistic for the outlook for SA equities, maybe UK equities, I would say I'm of the view that these geared market plays, 91 Coronation, for example, are looking very, very cheap. The yields are good. They're not capital intensive businesses. And a small move in AUM, and of course we mustn't forget the fact that 91 has done that deal with Sunlam where they're taking over a lot of the focused non-life mandates. I think that'll give them a beautiful boost to AUM. So yeah, it's a long way of saying I think both 91 and Coronation are looking to me very, very well placed right now, particularly if they were to get some new mandates that were maybe withdrawn because of rising rates.
Graeme, talking about that deal with Sunlam, do you think it'll get the green light, just considering the regulatory landscape we're currently in, with the Competition Commission really pushing back or not necessarily giving the green light to these big kind of deals? We've seen what's happened with Vodacom and Massive. We've seen what's happened with Sun International and Piermont.
Yeah, look, I think the reality of it is that, Sunlam will continue to operate. It's really just who's managing the AUM. And so obviously, 91, Coronation, Allan Gray, Sunlam, these are all really big players. But I would argue the market is sufficiently diversified. And I would say it's probably it's up to Sunlam to allocate that AUM to whoever they feel is appropriate. So I think it's more a business decision than a competition issue myself. But yeah, let's see.
All right, let's look at the travel and tourism industry, one that's poised to benefit this year as the economy improves, and more importantly, as we see those visa reforms also taking place. With that being said, we have a viewer asking what the growth prospects are for Tsogo Sun.
So Tsogo obviously is almost more of a gaming business. Obviously the hotels are an important part of that. But I would argue it's probably more of a gaming play.
Okay.
I think if you look at the 6-month results to September, if memory serves, both revenue and profit were down, not massively, but I think that just reflects the operating environment. Obviously you've seen, the online betting services, become a very significant part, and that's eating away at the gambling wallet. So myself, I'm not madly enamored with the gambling stocks generally. I think the hotel business arguably could do well, courtesy of visas. But I think in terms of South African consumer, which I would assume is the bread and butter of all, both gaming and hotels, I think South African consumers are under quite a bit of pressure, and disposable income under pressure. And that obviously, people may still gamble, but they're just gambling a smaller wallet. But now suddenly you can bet with, online sports betting, there's many of them in high profile. So I'm not mad about that, but I do agree with the narrative that I think inbound tourism will do well. But I would argue I'd probably rather look at a focused hotel group then, if that's your story, rather than maybe going for something like Tsogo or Sun, which is more of a gaming play. And we quite like City Lodge, and more recently the price has come off quite a bit. So I think City Lodge is looking good, and increasingly they're starting to attract those foreign travelers, where it was very much more of a business market. And if you look at City Lodge occupancy rates, if memory serves, back to above where they were pre-COVID. So I think the hotel story is looking better, but we would rather play something like City Lodge, which is clean and simple.
All right, let's look at MultiChoice. How would you value this stock if there is no canal? We think the price is held by that. Besides the deal, how do you view the company?
Not very well. I think it's worth a lot more to Canal Plus than it is to me as a shareholder, because I think, you know, the synergies and the opportunity to extract value and probably some savings is worth a lot more to a trade buyer than it is to the market. So, and you saw it, you know, in terms of the subs numbers and so forth. Obviously a deal that's, you know, wrapped in complexity, but yeah, I'm not mad about it. You know, I always say you can get Netflix, Amazon Prime, Disney, plus one other for the same price as your subscription. And I think the only thing that's really been saving them is the sport. But I think increasingly that's starting to get a little bit tired. So I'm not mad about the MultiChoice story. If you own it, I would argue, you know, just, you know, sell it. Don't take the deal risk. Bank it and move on. Yeah, and if you really like content, maybe go and buy yourself some Netflix or something like that.
All right. Before I let you go, let's get your stock pick, Graeme. What's one that you're liking right now?
Well, it's so funny, you know, when we're talking about, you know, companies offshore that are on 300 PEs and 99 PEs, you know, then I come along with this the story, which is COP, which is a South African integrated and diversified industrial business. You know, obviously forecasts are difficult and there's lots of moving parts, not least of which I think is, you know, PET prices, for example. But if I look at CUP, forecasts are for 42 cents for this financial year, maybe a little bit too optimistic. Let's put it at 35 cents. You've got a share that's trading at, you know, R2.70. It just looks so cheap. It's well run, trading well below net asset value. My personal opinion is they're very good allocators of capital. They're very good commercial managers, but they've also got a deal-making nous as well. So I think CUP ticks all the boxes, and you can see it. Even though they've been investing very aggressively over the last few years, you know, the debt obviously edged up. They're going to end the year with less debt than they started it with, and I think that's testimony to the cash generation. So it's probably going to take a little while, but, you know, if you say this thing could generate 50 cents worth of earnings, you put it on a 10 PE, you know, from 270 to 80, you're almost doubling your money, and I don't think it's a very risky story.
CUP one to look out for. Graeme, thanks so much for your time and just sharing those insights. That was Graeme Körner from Körner's Perspective. And that's all we have time for. But be sure to catch Stockwatch at 6:30 on Monday night for more stock-related analysis. Until then, stay tuned for lots more coming up right here on Business Day TV.